Good day, everyone. Thank you for joining today's webinar, which deals with immigrating from South Africa and immigrating into Malta. My name is Liane, and I'm an international tax consultant at Regan van Rooy. I would like to formally introduce you to our two presenters today, which is Irma Lategan, the head of private clients at Regan van Rooy, and Nikki Gouda, the founding partner of Seed. Today's session will be recorded, and we will also be sharing the slides. Irma, I now hand over to you to start today's session.
So hi, everyone. Thank you for joining us. So the discussion would have to begin on how to leave South Africa. So I'll just look at a few concepts. So what is the difference between the right to live in a specific country, citizenship of the country, and obviously tax residency? I'll also look at the tax residency system in South Africa, and then the implications of ceasing tax residency in South Africa, which would include exit tax, which a lot of people are not aware of and could have a big influence on whether you decide to leave South Africa or not. The sourced income in South Africa, which will always be taxable in South Africa even after you've left, and then the practicalities of advising SARS of you leaving South Africa. I'll also briefly look at what the influence is on retirement annuities in South Africa and your pension and provident fund rules. And then finally, we always discuss exchange control because it's very different from the tax consequences. So let's start by looking at the different concepts of the right to live in a country. So citizenship is broadly what passports you hold and in what country you are allowed to vote. So citizenship does not necessarily have anything to do with your tax residency. Then domicile is an important concept for certain countries such as the United Kingdom, Ireland, and also Malta. For South Africa, domicile is not an important concept. It's not defined in our Act, and it doesn't have an influence on your tax residency in South Africa, although it could broadly be similar to ordinary residency, which I will explain in a later slide. Then tax residency. So tax residency is what it's all about. So each country have different tax residency rules. South Africa defines it in our Income Tax Act of when you are resident in South Africa. And I will discuss that later. So tax residency is often also linked to the amount of days that you spend in a specific country or are out of a specific country. And it is possible for someone to be tax resident in more than one country. For instance, South Africa has the ordinary residency rule and other countries may have a days rule. So both countries would see you as tax resident in their countries and would want to tax you. But if that happens, the double tax agreement entered into between the two countries would normally have a tiebreaker rule in to determine which country have taxing rights on you. So the South African tax residency test, as I mentioned, it's defined in our Income Tax Act. The main test that you look at is the ordinary residency test, which is not specifically defined, but it is explained in our case law. And it is the real home, where your real home is and where you return from your wanderings. So it is a very subjective test, and it's all in your head of where you think you live. But SARS has indicated that it has to be supported by facts. And the facts that they normally look at is, for instance, where are your family based? Where are your friends based? Where is your economic interests and your social interests closest to? And they also look at simple things like, what does your Facebook profile say? Where do you live? So that's why it must be supported by facts like that. And you can only be ordinary resident in one country at a time. So ordinary residency is our main test in South Africa. The secondary tests that kick in if you are not ordinary resident in South Africa already is the physical presence test. So the physical presence test is easier to determine because it sets out specific days spent in South Africa. So you need to meet all three tests, subtests in the physical presence test. So the first question that you ask yourself is, have I been in South Africa for 91 days during the current tax year? So as you know, a tax year in South Africa runs from the 1st of March to the end of February the next year. So if you've met that one, so you've been in South Africa for 91 days in this tax year, the next question is, what have I been in South Africa for 91 days in aggregate during the previous 5 years in each of those 5 years? So if you meet that test as well, the third question is, have I been in South Africa for 915 days cumulatively over the previous 5 years? So you'll see it's a 6-year test basically. So first is 91 days in the current year, and then you look back over the previous 5 years to determine 91 days and 915 days in total. So if you meet the physical presence test, you will become resident in terms of the physical presence test in South Africa for tax purposes in the beginning of the 6th year. So that is the year that you're spending 91 days in South Africa now. And remember that the physical presence test only kicks in if you are not ordinary resident already. The main test is the ordinary residency test. So what happens if you cease your tax residency from South Africa and you become non-resident? So first, you need to obviously let the authorities know that you're no longer tax resident in South Africa, and that is a formal e-filing process. You fill in a form on e-filing with supporting documents to show that you've really moved your ordinary residency to a different country, and also you provide them with the time spent in South Africa during the last 5 years and now, so that you can prove that you've also broken the physical presence test. So as soon as you become non-resident in South Africa, there's an exit tax payable, and I've mentioned that in the beginning, and that's very important. A lot of people don't know about it, and there's a lot of questions around it. So exit tax for South African tax residents leaving is payable on your worldwide assets, except for a few assets, and I've listed them here. Your fixed property in South Africa, assets linked to a permanent establishment, meaning assets linked to a company in South Africa doing business. No exit tax on cash, and also no exit tax on certain restricted equity instruments. Now, a restricted equity instrument is an unvested share. So you will need to pay capital gains tax on other assets not listed here. The liability occurs on the day before you cease your tax residency. So for provisional taxpayers, there's an additional requirement that you need to submit an accelerated provisional tax return on the day before you leave, and you also need to pay your exit tax in order to avoid penalties and interest. For annual taxpayers, this liability only realizes when you submit your tax return at the end of the year, or July normally when the tax season opens, and then you get an assessment and you pay your exit tax then. So once you've left South Africa, you do not need to file an income tax return, except if you still earn South African sourced income. For instance, if you have a property in South Africa that you are renting out and you're earning rental income in South Africa, you will still need to pay tax on that. So you will need to file an income tax return in South Africa. Another thing that happens when you leave South Africa and you cease your tax residency is that you will enter into a split year of assessment. So as mentioned before, the South African tax year runs from the 1st of March to the end of February. So say, for instance, you cease your tax residency at the end of December. The normal tax year gets split into 2 shorter tax years. So the first year would run from the 1st of March until the end of December, just the day before you leave. So that year you will be tax resident in South Africa, and you would have to pay tax on your worldwide income. The short second year will start on the day that you leave, so the 31st of December or the 1st of January when you leave. And it would end at the end of February, the normal tax year for South African residents. For that shorter tax year, you would be a non-resident and you would only pay tax on your South African sourced income. So let's have a quick look at retirement annuities. So recently, the laws have changed on retirement annuities. Previously, when you emigrated and you ceased your tax residency, the retirement annuity could pay out immediately and you could take your funds offshore with your immigration allowances. But unfortunately now, you have to wait 3 years after receiving your non-residency certificate by SARS before those annuities can pay out. The funds can then be taken out with your exchange control allowances, because remember, tax and exchange control are two different concepts. So you will need to take it out with your exchange control allowances, which I will discuss later. And normally there will be a withholding tax within the retirement annuity, and that will be paid over to SARS. But this withholding tax is a tax on the person receiving the retirement annuity, and it's subject to what the double tax agreement says of the place that you are now resident in after the 3 years that you've left South Africa. So let's look at pensions and provident funds. Currently, you are allowed to do an early withdrawal of a pension and provident fund before you retire. So the normal retirement age is 55. When you do an early withdrawal, you will pay tax on that money that you receive. It will be taxed, a withholding tax within the pension or provident fund. If you withdraw before the age of 55, it will be taxed at a higher rate. But if you are at retirement age and then you make the withdrawal, then it's taxed at a lower rate. So it's always better to wait until retirement before you draw funds from your pension and provident fund. From the 1st of March 2025, National Treasury has actually proposed that a different system be used for pensions and provident funds, and it's called the two-pot system. So from then onwards, you will only be allowed to do one withdrawal per annum from a pension and provident fund, and it would be capped to 1/3 of the contributions that you've made from the 1st of March 2025. The remaining 2/3 is the retirement portion will have to be placed in a retirement annuity. So the reason why they're doing this is because the government was thinking that South African residents withdraw all of their funds from the pension and providence when they retire. They buy expensive cars and spend the money, and then they have no money left to live off from. So that's why they're forcing us to invest the 2/3 into a retirement annuity so that we can look after ourselves in our old age. So that's basically how the two-pot system will work from the 1st of March 2025. So double tax. So as I've mentioned, the tax in a retirement annuity is withheld, or a pension or provident fund, but it is actually a tax on the beneficiary. So what is the source of that funds that is paid out? In terms of the common law, the source rules would apply and say that when you contributed to that pension, provident or annuity, the source of the funds was probably because of the work that you did or the job that you held. And that would have been in South Africa if you're leaving South Africa. So the source would be South Africa. So therefore, South Africa would have taxing rights on that payment made to you from that fund. However, the double tax agreements can overrule that. So I've looked at 3 double tax agreements, the UK, Mauritius and Malta. Obviously Malta because we are talking about moving to Malta and immigrating to Malta. So if you look at the UK double tax agreement, it says that the pension or provident fund are taxed where you are resident. So the proceeds that you are receiving will be taxed where you are resident. So if you've ceased your tax residency from South Africa, you've moved to the UK, you're living there now, and after a time it pays out, then that money will be taxed where you are resident, which would now be the UK. So compare this to Mauritius. The double tax agreement between South Africa and Mauritius states that that money is taxable where it is paid from. So South Africa would have taxing rights in that case. So it's important to look at the double tax agreement. For Malta, it's a little bit more complicated. The tax agreement says that the payment may be taxed in South Africa where it is paid from, but it doesn't take away the Maltese taxing rights. So if you are a resident in Malta, you would have to claim relief from the tax already paid in South Africa from your Maltese taxes. So exchange control. So how do you take money out of South Africa through exchange control? So there are basically 3 allowances for South African tax residents. For non-residents, the first allowance is no longer available. So the single discretionary allowance is a 1 million rand allowance that you can take offshore, and you don't need any tax clearance or approval from FinServ or anything. You can take that money offshore without declaring anything to SARS or anything. So that's an easy one. It's unfortunately not available to non-residents. The foreign capital allowance is up to 10 million rand. So if a South African exchange control resident wants to take out funds between 1 million and 10 million rand, they have to go through the foreign capital allowance process, which has recently changed. It's a process that you do on e-filing. It's called the Approved International Transfer Process. So you fill in a form and you say what the source of the funds are that you want to take offshore. For instance, if you've sold a house in South Africa, they're going to ask you, what was the base cost of that house? When did you buy it? 15, 20 years ago. What was the sale price now? So that they can see that the source is not something illegal. So once you've gone through the SARS process, you receive a PIN from SARS, and that PIN is given to your authorized dealer, who is your banker, and the bank will assist you with transferring the funds offshore. So then you can also apply for more than 10 million rand to take offshore, but that's in terms of a more stringent process, and you need FinServ, or Exchange Control Financial Surveillance Department, is a department from the Reserve Bank, so you'll need FinServ approval to transfer those funds offshore. So that's the basic 3 allowances. And then just finally on exchange control, so I've discussed the 3 allowances on how you can transfer funds offshore. In 2022, the circulars were released by Exchange Control to say that we can now, as South African Exchange Control residents, keep any foreign inheritance, foreign earnings, or foreign donations that we receive offshore. We can keep it offshore without getting approval to keep it there. Just something to note is that if you've received a distribution from a foreign trust, you still need to get approval from FinServ to keep that funds or assets or whatever you've received from the trust offshore. It's not included in these allowances in terms of the circulars. And then finally, if you have assets offshore that wasn't authorized by FinServ to take offshore, it's offshore illegally, you run the risk of paying a penalty between 10 and 40%. And also exchange control contraventions is a criminal offense. So technically you could also go to jail. So it's very important to get exchange control approval for any funds that you want to take offshore. So that's basically from a South African perspective. I'm going to hand over to Nikki now to talk about the Maltese aspect of immigrating into Malta. Thank you.
Thank you very much, Emma. Good morning. Good morning, everybody. As Emma mentioned, I will be running through some points about immigrating into Malta. So I will be looking at, firstly, the reasons why individuals and families choose Malta. I'll be briefly covering also Malta's tax system, look into the various residence and citizenship programs which Malta provides in order for individuals or family to actually obtain residence or citizenship here. And finally, we'll also be looking at some vehicles such as trusts and family offices, which clients use for estate planning or inheritance planning purposes. Firstly, I would like to get into the reasons why foreign clients choose Malta. We speak a lot about taxes. Has spoken a lot about tax. I will obviously be doing the same shortly, but in reality, tax is probably one of the many reasons why families choose Malta. The first point I placed on my slide is security, and I always remember and tell the same story as to a few years ago. I had a South African family over in Malta and went out for dinner, and there were these group of children playing in the street on the pavement alone, unaccompanied by adults. And my clients were like, you know, how can it be? As in, where are their parents? Why are these kids alone? And I realized that from a South African perspective, security, so being able to live in Malta securely and safely, having children and have the children being, running around by themselves, that is a very important aspect as to why families choose Malta. Healthcare and education are also another two. So Malta has, I would say, very high levels of both healthcare and also education, and then also obviously the access to the European Union. Malta, as a fully fledged European Union country, provides access to the rest of the European Union, and probably more importantly in this discussion, to the rest of Schengen, to whoever obtains residence or citizenship there. What I would like to cover next is tax. So whilst tax is simply one of the reasons why they choose Malta, tax is obviously a very, very important aspect as to what happens when individuals become resident in Malta. So as we can see from the next slide, what there is tax residence in Malta. So Malta, similarly to the UK, for example, does not tax on a worldwide basis. So when foreign clients become tax resident in Malta, Malta taxes on a remittance basis. So such individuals will be deemed to be resident but not domiciled in Malta, and would only be taxed on income and capital gains arising in Malta and foreign income which is received in Malta. So any foreign income which is not received in Malta is not taxed. Furthermore, any capital gains arising outside of Malta would also not be taxed. So in the example we have on screen, for example, we have the individual who is resident but not domiciled in Malta. He or she owns 2 South African entities. From SACO 1, there is a dividend distribution to the individual, and that dividend income would not be taxable in Malta unless it is received here. In addition to that, because of the South Africa-Malta tax treaty, the withholding tax at South Africa level will be reduced to 10%. So you have a reduction of withholding tax to 10%, and then no further tax in Malta unless those funds are actually received here. In the case of SACO 2, the individual who's tax resident in Malta sells SACO 2, makes a gain from that sale, and there again, Malta would not tax that. Malta would not tax that because it's a foreign capital gain, and Malta does not tax foreign capital gains irrespective of whether they are received in Malta or not. So this is basically the essence of individuals who are residents but not domiciled in Malta. There are, as we'll be seeing next, a number of programs as to how individuals can obtain residence in Malta. Here I'm highlighting the main two programs which families use to obtain residence in Malta. They are different in the sense that whilst the MPRP, so the Malta Permanent Residence Program, provides permanent residence to the individuals and the families, the GRP, which is the Global Residence Program, is a tax residence program. So automatically individuals would become tax resident in Malta as a result of being beneficiaries through the GRP. However, even though both programs are different, they are quite similar in nature, in the sense you would always need to either lease or acquire property in Malta. There are certain donations which one would need to be made, particularly under the MPRP. And in terms of timing, one is looking at anywhere around 4 to 5 months for the whole process to be completed. I like to say that relocation is a very personal choice. So there isn't one case which is similar. So in order to decide which of the programs is more suitable in the current scenario, we like to understand what the ultimate goal of the clients and the family is, and then understand whether the MPRP or the GRP would be most beneficial. In terms of costs, roughly, one would be looking at around, I would say, 150,000 in order to obtain residence, whether through MPRP or GRP. What's important is that the residence in Malta gives clients access to Schengen. So the residence card which clients obtain post going through the process serves basically as the Schengen visa in order to access Malta and the rest of Schengen. Apart from residence, as most of you know, Malta also has a citizenship program. So Malta also provides a path to citizenship, which could be either of 12 or 36 months, upon the satisfaction of a number of conditions. So the path to citizenship is a path which does not only lead to the individuals and the families obtaining a residence card, but they also obtain a passport, a Maltese passport, which is beneficial of itself, because apart from giving access to a number of countries, it also, as I mentioned earlier, gives access to the rest of the EU. In terms of timing and costs compared with the residence program, it's fairly different. So as I mentioned, the quickest possible time in which to obtain citizenship is 12 months. And in terms of costs, what one family would be looking at is roughly probably somewhere below €1 million in order to obtain citizenship here. Two important aspects on this is the following. Firstly, both the citizenship program, but also the residence programs I mentioned earlier, those are always 4-generational programs. So they could include parents, grandparents, and children, and then anybody born from individuals holding a Maltese passport would also obtain and be granted a passport as well. And as Irma mentioned earlier as well, obtaining citizenship in Malta does not lead to any tax implications. So there's a distinction between citizenship and tax residence simply because one obtained a Maltese passport or Maltese citizenship does not mean that they are tax resident in Malta. They could, if they want, decide to be tax resident here, either because they spend more than 6 months in Malta or because they register as being tax resident in Malta. But the simple fact of going through the whole process and obtaining Maltese citizenship does not automatically lead to tax implications. Finally, what I wanted to touch upon as well is the trust and family office. So a number of clients, whether they would have obtained residence in Malta or not, look at Malta to set up their trusts or family offices for estate planning and inheritance purposes. Malta's trust system is very much similar to Jersey's. From our corporate law and even from our tax law, it's also very similar to the UK. So we see a number of families setting up their trusts and family offices, which could also be in the form of a trust for estate planning and inheritance purposes. Typically, it would be that the parents and the children would be the main, whether primary or secondary beneficiaries, and then all the assets of the family would be held in the trust. Malta also has the aspect of protectors, similar to Jersey, so that also gives peace of mind to the settlor and to the family that the assets are being held by the trustees in the best interest of beneficiaries. So these are structures we see being set up many times. Again, tax is one of the aspects, but definitely here what we're looking at is security. Security in terms of ensuring the family's assets are held for the best interest of beneficiaries. I know I gave a very, very brief explanation of how Malta works from a tax resident perspective, but obviously if anyone have any questions now or later, please feel free to let me know. I'll revert back to Irma to continue the session. Thank you very much.
Thank you very much, Nikki. That was very informative. So this was obviously a very condensed session because I know people lose interest after half an hour of discussion, of very technical discussion. So there's a lot of tax planning that goes around leaving South Africa, setting up offshore vehicles to your benefit before you enter into another country, and also considering the tax and other legislative implications of moving to another country, because the law in South Africa does not follow you, and people often forget that. So contracts entered into in South Africa would not necessarily have the same effect in the country that you are going to. So there's a lot of tax planning around leaving South Africa, entering Malta or any other jurisdiction. And if you guys have any questions, we will circulate these slides, and our contact details, both mine and Nikki's, are on the final slide. So you are welcome to email us with any questions or make contact in another way. Thanks, guys. Thanks for joining.
Thank you.